So the current question that we are going to discuss from the chapter capital structure, where we have to prepare income statement and leverages. So this particular problem is only stating upon preparing income statement alone. In case if there is anything required in continuation, you can follow the formulas for financial leverage, operating leverage, combined leverage as usual. So picking up the current question, it says the total amount of units which every single firm is producing. So we have three firms in comparison and their datas. So output, that basically means how much amount of production does every single firm has gone through in its time. So A has done 1,20,000 units, 30,000 for B, and 2 lakh units have been produced by firm C. Comparatively, the next one is operating cost. Now operating cost basically means whenever there are total combined cost of fixed components and variable components both put together. Fixed and variable, when both are put together, will be called as your total operating cost. So they are 3,80,000 rupees, 7,30,000 and 70,000 for firm C. Now variable cost per unit, they have not told you the exact amount in rupees, rather they have given to you in percentage forms. Okay, so whatever amount of value that we are going to arrive at is giving at a percentage, and when we find out the value of sales, on the value of sales we will calculate this percentage. I will also let you know when we are calculating the answer. Meanwhile, we have 30% for B and 20% for C. 10% borrowed capital. Now either you can write this as to be debentures, or you could call it to be 10% borrowed capital. Both of them will mean the same. So it's 8 lakh, 16 lakh, and firm C has no borrowed capital. Selling price per unit will be 6, 50 and 1. Tax rate 40% for all. So what we are expected to do is, first we are expected to draft the entire statement. I have already drafted the income statement. Now one after the other I will start telling you as to how exactly did we arrive at the respective numbers for every single firm. Now upon drawing the income statement, we start with the first particular, that we are starting with sales. Now how did we arrive at sales? The unit of production is multiplied by the amount per unit, or you can say price per unit. So 1,20,000 multiplied to 6 will give you 7,20,000. 30,000 into 50 will give you 15 lakhs, and simultaneously 2 lakhs into 1 will give you 2 lakhs. So that's how we started with our sale price. Moving on, out of the sales we have to reduce our variable cost, all those which went into production. Now variable cost is not very directly given in the question, it is given in the form of percentage. So 33.1 by 3, if you break this fraction into percentage, it will become 33.33. So 33.33 of 7,20,000 will give you 2,40,000. Similarly, 30% of sales will give you 4,50,000, and 20% of the sales will give you 40,000. Right? Now if you deduct these two, you will arrive at your contribution 4,80,000, 10,50,000 and 1,60,000. Next, major important, the only catch in this particular question is fixed cost is not very clearly given in the question here. Now if you have to find out, the most important key is this, total operating cost. Now in the question, when we've already found out variable cost, and operating cost basically means fixed cost plus variable cost both put together. Now amongst these, one component we've already found out, then out of the total, if you minus one, automatically you will get the value of the fixed cost. That is what we have done here. So total fixed cost is how much in the given question? Total operating cost is 3,80,000. If I deduct 3,80,000 minus 2,40,000, remainder whatever you get is 1,40,000. So total operating cost for firm A was 3,80,000. Operating cost involves both fixed cost, variable cost both. Now what exactly do we do? Out of this, if we even find one element, if my variable cost for firm A is going to be 2,40,000, then automatically difference between the two will become your fixed cost. This is how exactly we are expected to find out. Okay, so what we have done, 3,80,000 minus 2,40,000 will give you 1,40,000. Simultaneously, you do the same thing for B as well. 7,30,000 minus 4,50,000 will give you 2,80,000. 70,000 minus 40 will give you 30,000. After you arrived at your fixed cost calculation, it is very important to mention this in detail while you're appearing this in the question paper, because explaining to the valuator as to how did you arrive at a particular value is very important. Otherwise, which in most of the university or many a times how I have seen valuations happening, they tend to, if the valuator does not comes around finding the exact reason of how did you get the answer, they may consider this to be as copied. So please be on a safer side. Explain every single element like this, how, I mean, in a much better way of how did you arrive at the number, and then take it forward. Okay, so after we've done this fixed cost, we have to arrive at EBIT. Very simple. By now all students would have known how exactly do we arrive at EBIT. It is contribution deducted by your fixed cost. You will arrive at your earning before interest and tax. So difference between these two will become here 3,40,000, 7,70,000 and 1,30,000. Okay. Now what exactly do we do after we have said in earning before interest and tax? So it is before interest, so the first element will be taken. So first we will deduct interest, then we will deduct tax. Okay, so any company's first responsibility is towards whatever income that you have generated. First you pay towards people whom you have borrowed capital in the form of loan. Okay, debenture is nothing but long-term interest-bearing securities. Any kind of capital which is a kind of loan for a long duration of time. Okay, for which you generally pay interest. Now in the capital they say 8 lakhs is the capital, and how much amount of interest are you paying? 10%. How much is 10% of 8 lakhs? 80,000, and 10% of 16 lakh? 1,60,000. Similarly is been written here. And out of the total EBIT, interest gets deducted to arrive at EBT, earning before tax. So out of these deducted values, we will calculate tax to finally arrive at earning available to equity shareholder. Now what is my tax? 40% of the total income generated so far. 40% of earning before tax. So 40% of 2,60,000, 40% of 6,10,000 and 40% of 1,30,000. When you come up the figures, this is what you get: 1,04,000, 2,44,000 and 52,000. Deduct between these two and finally arrive at the value, that is 1,56,000, 3,66,000 and 78,000 as earnings available to equity shareholders. And in case now if the question is asking you to take it a little bit forward, you can also calculate financial leverage, operating leverage and combined leverage. I hope we have no other issues regarding this particular problem, and we have clearly understood various terms, how do we find out missing values and how do we interpret the entire question. So let us start with the next variety of a problem. Now what does this question say? The existing capital structure of a company has the following details given. Now these are all those type of data that a company actually owns. Okay, this much amount of capital a company is already raised. Now how much a company already has a capital? It has equity share of 100 rupees each worth 40 lakhs, retained earnings of 10 lakhs. Sometimes they also give you plowing back of profits, internal capital, so words could be different, 9% preference shares 25 lakhs, 7% debentures 25 lakhs. Okay, now what is the question telling? The company is not happy or maybe is in need of additional capital. Okay, there could be wide variety of reasons. It could be diversification, there could be expansion in the sense they would want to increase the number of production of units, maybe they want to make some long-term investment. So for that reason there could be any, depending upon the type of industry or the company. So this particular company, the next information is they are earning a return of 12% and the tax on income is 50. This is additional information. Actual question is a company wants to raise another 25 lakhs. So this is already existent. In addition to this, they extra want 25 lakh rupees of capital for its expansion project, for which it is considering the following alternative plans. So the first alternative is either you issue 20,000 equity shares at a premium of 25 rupees per share. Okay, now what will happen? This 25 will basically be calculated as 125. So actual capital will be 25 lakhs only. But this additional 25 rupees into 20,000 will be something that will go directly to your share premium account. Additional benefit for any company will not be taken as inclusive in the capital. Now how we are actually going to deal with this in numbers, I will show it to you when we are doing our income statement. So the first alternative is that all this capital put together plus additional equity shares, so only in the form of equity. Second alternative is issue 10% preference share. So this is my second alternative of 25 lakhs, completely issue 10% preference shares. Okay. Third alternative is don't go for equity, don't go for preference. Last option left is issue 9% debentures. This becomes my third alternative. Okay. So with the existing plan, how exactly are we going to get drafted? See, first important thing is it's very important for us to pen down, write down, make a note of all the type of varieties that any company can raise from the market. So now for this example, if I am taking only the first one, existing will be this. The second option will be I will have additional equity, old equity plus new equity. Second plan, retained 9%, 7% debentures. We will have 10% preference share, 9% second, third alternative. So all of this has to be written in a particular format so that when you're actually drafting the answer, it does not becomes confusing. Now before going to the answer, let us also see what does the last portion of the question say. It also is telling that there is projected profit earning ratio. Case of equity preference debenture, it will be 20, 17 and 16. This is generally to find out the market price of the share. Okay, so to continue with the answer, just keep one thing into mind. This is not one plan. Okay, 25 lakh is not getting distributed between all the three. It is in different plans. So this becomes your existing plan. Then second one, all of this, then only in the form of equity adding to it. Then third one will be all of this plus preference. All of this, next one is only debenture. So this is exactly how it should look like. Please don't get confused that 25 lakh is raised between all the three. No, it's not like that. It is in only equity, only preference, only debenture. Okay, so we will just look into as to how exactly income statement is being drafted. And for better understanding, it's always advised that you write down the question that is on the screen right now, and please see to that you work accordingly, because practicing is something that can actually improves your skills while you're doing practical papers. So it will be much better that along with learning, you also write it down or maybe pause it and find out the answer and then rectify whether you're doing it properly or not. Okay, so let's just move on to the answer. So this is how exactly your first pattern of understanding total amount of capital raise has to be drafted. Because what happens is when you have multiple types of investment options or multiple investments that are available, it so might happen that you lose out on one and two and the entire efforts of writing an answer goes waste. Okay, so it is preferred, so whenever you have multiple options like this, kindly pen them down in different alternatives so that it becomes easy for classification, good in representing, and also you land up finding the correct answer. So what are we going to do? The plan is we are going to show contrary differences, or we are going to show the contrast between what was the actual change between the current position and after which, when the company actually decided to raise 25 additional capital, which of the following alternative should you actually plan? So first alternative will go towards equity, second one will be preference, and third one will be debenture. Okay, now according to the question, what was the exact question given? We had equity, we had retained earnings, we had 9% preference shares, and we had 7% preference shares. Okay, now in contrary to that, how exactly did we get 60 lakh worth of capital? here as equity. Now because you already know equity share capital, first one was already existing, and later on what happened, we had to additionally raise 20,000 of capital. Okay, so the question basically say raise 25 lakhs of 20,000 shares each. So that was the question. Now whenever we are actually calculating, the question said 125 is going to be the premium price at which you are actually going to collect equity share capital, right? At 125. Now how did I arrive at 125? Actually the question told 25, but the base value was 100. Okay, premium of 25 this is. Okay, premium of 25. And generally if you see in the existing capital, this was the actual value at which equity shareholders were actually purchased from the public. So 100 was the base value, premium price at 25 each. So the value became 125. Now what exactly we are doing? Whenever we have to calculate for the capital structure, we will not take 125. Rather we will consider 100 for equity share calculation, and the remaining premium price, whatever you are earning, will go to your share premium account. Okay, this will go to your share premium account. So basic understanding, in the question they have told you to raise 20,000 shares of 125 each, right, at a premium value. And if you do 20,000 into 125 will give you 25 lakhs, right? This much is clear. We are expected to raise so much only. That was the question. Now how exactly we are splitting, or how exactly we are going to show this in the statement? Base value 100, premium value 25, we add it together. But what exactly goes in my calculation is, I will only take 100 and 25 value per share. So 25 into 20,000, 5 lakhs is something which will go to your share premium account, and 100 into 20,000, 20 lakhs will be used to calculate equity share capital. Okay, just understand this particular thing. Base value, premium value, actual value per share will become 125. For our calculation, because we have to raise additional 25 lakhs, okay, if you do 20,000 into 125, 20,000 into 125 is 25 lakhs. But how much are we actually going to write here is 60. How did we arrive at 60? The capital that we already had was to the extent of 40 lakhs. In the calculation, because it is raised at a premium price, we will not take it in the calculation for equity share. Rather, we will only take the base price, multiply this with the number of shares, and find out 20 lakhs. It does not mean we are removing that amount of additional 25. Okay, we will consider this to go in the share premium account. It will be there with the company only. Okay, this is what it is, just a mode of collecting money. Okay, depending upon the stock of the share, maybe the value is very good or the demand is good, so the company is charging them more. Okay, you don't have to get deviated from the topic. Alright, this will come to the company only, but we will consider the value to be base. That is why it is 60. Okay, here it is 60. If there are any more not understanding students, you can write in the comment section below. I can figure out some even better modes to for things in Hindi or maybe any other language where I can make you understand, because there are sometimes students who are of maybe non-commerce backgrounds who may are studying this particular concept and may find it a little deviating. It's not just that commerce can understand even better. There are a few who take a little time, but just keep one thing into mind: whenever shares are done and whenever capital structure decisions are being done, we will take base price into consideration. Anything that you're charging or collecting in the form of premium, more than the base price will go to your share premium. That's all. So when you're calculating equity share capital, number of shares into base price. 40, this was the old capital raised in the form of equity share. This is the new capital raised in the form of equity share. Okay, this both if you add, you will get 60. Right? So 60 here and 40 will remain constant in the case of preference and debenture. So this is what I was telling, 5 lakhs that I told you here. 20,000 share multiplied to 25 will give you 5 lakh. This will go nowhere. This will come as a part of share premium, as a separate heading, that's all. Next one, retained earnings will remain constant for all. Whatever was already there will be for everything. Next one, 9% preference shares. It is something that was constant. It was purchased during the current position only. There is nothing extra. So this applies to all. Okay. Now additional, now first equity part we have already discussed. Right. So if you are raising additional capital only in the form of equity, we made changes here. In the second plan, we are raising 25 lakhs only in the form of preference. That is why these things are blank. In the third option, we are raising 9% debentures only here. That is why the others are blank. Okay, for simple reasons. I hope it's clear. Okay, we are raising in the form of additional preference shares, so it is here. Additional debentures, so it is only here. So once when you make this particular table ready, it will become even much more easier for you to find out how much is the total amount, what will be the number of shares, how much amount of equity you have, how much amount of preference you have, how many types of preference and debentures you have. This will become a little bit more easier, okay, to solve your income statement, right? Now moving to the next one. After we have calculated all of this, we found out, add all of the above and you will get 1 crore, 1 crore 25 lakhs and similarly. Next, it is important for us to find out the actual amount of income statement calculations. Now, since the question is telling nothing indirect with respect to sales or variable cost or anything else, but there is one important thing which I noticed was the company said in the question that total amount of returns was 12%. Now, what is this returns? Whenever a company is taking capital from the general public, it is very obvious that any company is not going to sit and stare at it. They will invest it somewhere. If you are investing it somewhere, there will be some sort of returns on that particular capital. Okay, so EBIT is that number that we are going to start calculating with. Okay, EBIT will be the base level where we are going to start this particular from, and since the question is telling 12%, 12% will be calculated on the capital employed. Okay, 12% returns on capital employed. Okay, so when we are starting our EBIT, it should be 12% on the capital employed. Now what is exactly capital employed? Total amount of capital that is raised by the company via different sources. Okay, so when we have already found out the totals, out of these only we will calculate what is our earning before interest and tax. Now they say 12%, so we will calculate 12% on the capital employed, 12% on the capital employed, and then we will get the answer. So 12% of 1 crore is 12 lakhs, 12% of 1 crore 25 lakhs will become 15 lakhs, 12% of same answers. Alright. After this, there are many students who are very intelligent, who will solve the problem even before I complete it. So let us quickly go through what exactly will be the next item. So obviously, if it's a earning before interest, interest is the first component, so we will take interest first. Deduct interest on debenture. Now it is very important to calculate and show how much amount of debenture interest are you giving. Now in the first alternative, we have only one form of debenture, that is 25 lakhs. 7% of 25 lakh is 1,75,000. Right? Next, again in the second alternative, what do we have? Second alternative also we have only one debenture. One debenture of 7%. 25 lakhs into 7% will give you how much? 1,75,000. Now for the third one, what happens? Again we have only one form of debenture, right? So 25 lakhs into 7% will give you 1,75,000. Last alternative, what exactly did we do? In the last alternative, we already had debenture or loan, borrowed capital worth of 25 lakhs. But in the fourth alternative, because we are preferring to raise capital in the form of debenture, we additionally raised 25 lakhs. So in the fourth alternative, total amount of debenture that we have to the extent is 50 lakhs. But it does not mean 50 lakh into 7% or 9% you do. You basically have to do your calculation something like this. So first one, 25 lakhs into 7% is going to be 1,75,000, and 25 lakhs here, 25 lakhs into 9% is going to be 2,25,000. If you add them together, you will get 4 lakhs. Total amount of interest payable on debenture, we have two varieties of debenture available in this particular alternative, right? So we will pick 4 lakh as the amount here, 4 lakh as the amount, right? So we quickly deduct EBIT and interest, then we arrive at earning before tax. Tax compulsory contribution has to be made by the company on total amount of revenue that they have generated throughout the entire year, and generally the government also fixes a particular percentage. So in this particular case we have 50%. 50% is expected to be calculated on the earning before tax. So on each of these alternatives we will calculate 50%. 50% on this, all the alternative. Then we arrive at the answer. For the current plan we'll have 5,12,500, 6,62,500, again 6,62,500, and for the fourth option is 5,50,000, right? Now there are many brilliant students who would have also completed the problem, but for the others, let us go through the next one. It says earning after tax. So when we deduct both of these components, we will arrive at one figure number that says earnings after tax. Here same value because it was 50%. Now out of this, what is pending? We have already made we have already given returns to the people who had borrowed, who had given us capital in the form of loan. We have also set off our compulsory contributions to the government in the form of tax. Now what is remaining even before equity is the preference dividend. Okay, so in preference dividend, now we'll just see one table. It says here, in the current situation we had how much amount of preference? We had 25 lakh worth of 9% preference share. 25 here, two types of preference, because in the plan 2 we are raising additional 25 lakhs only in the form of preference. So we will have two types of preference. One was existing, one is additional preference shares for expansion program. Okay, so this will become 50 lakhs here. But 20, we will have to calculate this separately. Please be very careful. 25 lakhs into 9%, 25 lakhs into 10%. That is what we have to calculate. So the alternatives are here. So first one is 25 lakhs into 9%. Next one is again 25 lakhs into 9%. 2,25,000. So we have two alternatives here. 25 lakhs of 9% and 10% of 25 lakhs. So we'll have 2,25,000 and 2,50,000. Added together will come up to 4,75,000. And the last, again we have only one option of preference dividend available, so we'll write 2,25,000. Replicating all of these numbers in the income statement, what do we arrive at? We have replicated all the numbers here, right? So this is one advantage of when you're writing a total elaborative statement of what is being raised in which form. It becomes little easy for you to calculate. And please make sure that you make certain small notes like this in the examination as well, so that it is very clear from the valuator's point that whatever calculations you have done is proper and it's in its right manner, and they exactly know as to how did any value come from, all that. So it will be on a better side. Okay, so the question say again deduct preference dividend, whatever is remaining after setting off returns to debentures, to the government, to the preference dividend, whatever is the returns or the revenue generation pending, it's completely enjoyed by the equity shareholder. So in the existing plan, you will have 2,87,500. You will have 4,37,500 when you're raising only in the form of equity, 1,87,500 when you're raising in the form of preference share, and dividend whenever you're raising, the profit becomes 3,25,000. Now, in case if the question is asking you, tell me only on the basis of earnings available to equity shareholder, which one would be the option that you would recommend a company to opt for? So it is very obvious, whichever earnings that you are getting highest in number, you will opt for that. But in case if the question is asking you to find out best returns on the basis of earning per share, so you will also have to calculate earning per share. So how would you do that? Total earnings available divided by the equity shareholder, total number of shares you will get. 40, 40, 40, because the existing number of equity shares in these three plans were 40, but only in the plan 2 we had raised additional 25 lakhs in the form of equity. The calculation was here, right? 20,000 shares. So existing 40,000 plus 20,000, it will become 60,000. So when you divide your earning available to equity shareholder divided by the number of shares, you will automatically arrive at what is the earning per share. So depending upon the earning per share, whichever is the highest, we are going to recommend that. So in this case, plan 3, 8.13 something that is giving you the highest of returns. So we are going to choose this. Next, we had one more component, which was your profit earning ratio. That is to find out what exactly was the market price which is prevailing. So when you have these three values given in the question for three alternatives, for the current it is not there, so we have kept it nil. We just have to multiply earning per share and the profit earning ratio. This was the EPS. If you multiply these two, you will automatically get your market price. Earning per share multiplied to profit earning ratio. So amongst this, again, it kind of depends upon the question to try to trick students. So sometimes they can ask you, tell me which alternative would you choose. If it is only on the basis of earnings, then it will be this. If it is on the basis of earning per share, then it is this. Okay, so please read the question very carefully before you give your conclusions or before you give your answers as to what would be your suggestion or what is your conclusion. Depending upon the income statement, what do you suggest to the company, that which form of alternative should the company actually choose, that they are profitable, that they actually earn additional amount of revenue, or you recommend which actual plan should be chosen by the company. Okay, so that way, so there are different alternatives, different types of questions which generally may come. It's very important that you read the question very wisely and then take it forward. I hope this particular question was understood, including. So the next question under chapter financial leverages, you can say capital structure, anything. Okay, so a private company has earning before interest and tax of rupees 4,80,000 and its capital structure is of the following securities. So how much amount of capital you have actually raised via different sources available. So equity will be 4 lakhs. Preference share capital, I'm so sorry for using short terms, you please don't do that, 6 lakhs. 14.5% debentures of rupees 10 lakhs. So it's 20 lakh worth of capital, and the total amount of operating income that you're actually having is 4,80,000. Okay, using this particular data, we are going to draft our income statement to find out two important fluctuations. Now the question is asking us to do what? To find out what will be the change in the earning per share. Okay, whenever we are changing our EBIT, what will be the effect on the earning per share? If your EBIT is increasing to 25%, so 4,80,000 plus 25%, and if your EBIT is reducing by 20%, 4,80,000 less 20%, and the corporate tax being 35%. So firstly, we are expected to draft one income statement which has particulars column, the existing EBIT column, plus 25% and minus 25%. Alright, so these are calculations that we are expected to do. First, EBIT 4,80,000, that is already given by the question here. Next, 25% increase. So 4,80,000 plus 20% is going to be how much? So it says 4,80,000 into 20% is 96,000. 25% increase it is. 25 is 1,20,000 plus 4,80,000 will become 6 lakhs. Okay. Next, similarly, if you are reducing by 20%, 4,80,000 minus 20% will give you 3,84,000. Okay. So upon 4,80,000 minus 20% will give you, okay, sorry if I am wrong, 3,84,000. So same amount we are writing it here. No much deviation. We are going to follow the same concept. Minus interest, minus tax, minus dividend, and find out what is your earning per share. So firstly, your interest is going to get set off. The amount of value of debenture is 10 lakhs. On 10 lakhs, we will calculate interest being 14.5%. Okay. So amongst our total income, first responsibility of the company is to give away returns to the people who have contributed capital in the form of loans. Okay. Debentures are nothing but loans. So 1,45,000 for each. Deduction of EBIT minus interest will give you earning before tax. And the question say corporate tax is going to be 35%. So 35% has to be calculated upon EBT, earning before tax. 3,35,000 into 35%, 4,55,000 into 35%, 2,39,000 into 35% will give you these three figures. When you deduct earning before tax and corporate tax, you arrive at earning after tax. Earnings which are available after making contributions to compulsory contributions which are tax. After this, the third last important individual who is remaining is your preference share before actually equity can get their share of profits. So equity shares, basically what do we say? We have 12% preference shares of 6 lakhs. 12% preference shares of 6 lakhs. 6 lakh into 12% will give you 72,000. Right? So we just have to calculate and see. 6 lakh into 12% will give you 72,000. So 72,000 applicable for all the three. If you deduct earning after tax minus the preference dividend, you will get earnings which are available to equity shareholders. After this, we divide with the number of shares available. So total amount of capital in the form of equity share is 4 lakh and one share is of 100 each. 4 lakh divided by 100 will give you 4 lakh divided by 100 will give you how much? It is 4,000. 4,000 shares each. So earnings available to equity shareholder, each of these earnings will be divided by the number of shares to arrive at earning per share. So this was something which was very common that we've already done, but the actual thing is we will have to find out what will be the change in earning per share. The formula is very simple. We have to basically show contrast between the existing and increase, existing and decrease. Okay, show contrast between existing and increase, existing and decrease. So the formula will be change. So this particular triangle itself depicts change in the earning per share minus the old earning per share divided by old earning per share into 100. So the difference is already seen, but the difference that you see here is actually earning per share in terms of rupees. The question is asking you to find out what will be the change in the earning per share in the form of percentage. Okay, there could be a certain requirement that the company has to project these numbers to their stakeholders. Stakeholder could be government, creditor, any other form of way that you actually have to project what percentage increase has actually happened. Okay, so these are actually value per share in rupees. We will have to find out what is the change. Existing to increase, existing to decrease in the form of percentage. Okay, so actually increase was 55, 36 divided by 36. Change in equity per share, existing by existing into 100 will give you 53.5. So if you increase your EBIT to 25%, there will be an increase of 53%, approximately 53.5% increase in the earning per share. Now what will be the scenario if you reduce it to 25%? Again, existing minus the amount that is 20% decrease is 20.84 earning per share. The existing again divided by existing into 100. So in case actually whenever you reduce your EBIT by 20%, the value of per share also will reduce, and it will reduce to a percentage of 42.81 percentage. This is exactly what we are trying to make it understand. So the entire catch in this particular question is only that what will be the exact change in the earning per share. Okay, sometimes there are questions which are asked on the basis of changes in EBIT. Okay, either EBIT or EPS formula remains constant. So it will be, for example, if they are asking you the same question in the form of EBIT, so you will do 6 lakh in case if it is EBIT, 6 lakh minus 4 lakh 80 divided by 4 lakh 80. 6 lakh minus 4 lakh 80 divided by, that will be 25%, right? It's very easily done. The only catch is in EPS. So these kind of problems are generally asked either when you have to show contrast between the earning per shares here in this kind of formula, either when you have to show contrast between the earning EBITs, change in the EBIT, formula stands the same. The new change minus the existing into 100 divided by the existing. So you have done 55 minus 36.4. Then you actually compute in the form of percentage and then show it across. So the next question says, it's a very simple problem. It's only that how do you show differences between two forms of EBIT. Okay, so a company has 1 lakh divided into shares, one capital of rupees 1 lakh of 10 rupees each. Okay, so this particular company wants to go for one expansion program of investing another 50,000. So 1 lakh is already there and another 50,000 they want to invest. Now this particular 50,000, the mode of which they are going to raise is of all these three. Okay, issuing 5,000 shares of 10 each, issue of 5,000 12% preference shares of 10 each, issue of 10% debentures of 50,000 each. Tax liability to be 50%. Now actually what you're expected to do is 50,000 is raised among these three options. Okay, so we will have three different plans, right? What exactly is being asked in addition to this is, tell me what would be the calculations if your EBIT is continuing, if your earning before interest and tax is going to continue, and in case if it is increasing to another 10%, 10,000. So if your existing EBIT is 30,000, so calculations of all the changes here with 30,000 EBIT, again a full income statement with increase of 10,000, so 30 plus 10 will become 40. Okay, so firstly when you are drafting your income statement, this is exactly how it should look like. Starting with your plan, only equity, only preference share, only debenture. Three forms here, equity, preference and debenture, right? So first plan has 30,000 EBIT, we are continuing with this. 30,000 EBIT applies for all. Now, first we start with interest. Now interest is how much? Now interest will only be applicable to the third plan because here is where debentures are there and only to debentures you pay interest. So 10% of 50,000 is 5. So we are writing 5,000 only here in the third alternative. While you deducting, you arrive at 25,000 in the plan 3 and EBT remains 30 here. Similarly, next tax 15, 15, 12.5, 50% on the respective EBT. If you deduct these two, you will arrive at earning after tax. After tax means interest is given, government is given, preference dividend is what is pending. So preference dividend becomes a component of only the second one. So now what does preference dividend say? It says 5,000, 10 each. 50,000 into 12% will give you 6,000. So 6,000 will be given to only plan 2, neither of 1, neither 3. Okay, because we are calculating or raising in the form of capital only for the second plan. We are just trying to show contrast between three alternatives of which particular way or which form of capital if I raise, the company will be more beneficial. Okay, so because you have it here, the remaining remains nil. Earning after tax minus preference dividend, you will get the following numbers. Now the only one component that is expected to be found out is when we are finding earning per share. Okay, to find out earning per share, what do? earning available to equity shareholders has been divided by the number of equity shares. Now the entire catch in the problem is all about finding the total number of equity shares. Now here in the first alternative, what happens? We already had capital of rupees 1 lakh. If 1 lakh is divided by 10, how much do we get? 10,000 shares. Now in addition to this, we are raising additional 5,000 shares. So 10,000 shares plus 5,000. So old shareholders plus new. It doesn't mean that the shareholders who had already contributed their capital even prior will not get dividend. It cannot happen. So that is why to bring the new number of shares, we will do old number of equity shareholders plus new. How did we get new? Here. And old 1 lakh divided by 10 will give you 10,000. And the others will remain constant because we are raising in the form of preference and debenture. So this will become 15, 10 and 10. So this is one very important component to be noticed, because most of the time only while you're calculating EPS directly we will take only the new one and then we will continue, forgetting the fact that whenever there is income that is generated, it's not just the new people who have contributed to the capital enjoy dividend, but also the existing or the old shareholders. Right, so if you had purchased shares like 10 years back, do you think you will not be eligible to get dividend? Definitely not. You will get dividend, right? And along with you, the existing, this 2020, whoever has invested, they also will get dividend. So the same logic applies here. It's not just the new shareholders, but the existing or the old ones also get their share of returns. So it is 15,000 here. So total income divided by the number of shares, you will get 1, 0.9 and 1.25. Now if I have to say, you have to apply the same formula when your EBIT increases to 40,000. Now in case if some students can just pause the video and see if you can try doing it by yourself, where your interest and your preference dividends will remain constant. I hope many of you will be capable of doing, and for the ones who are not, I will just tell you once again, this will remain constant, this will not change. They are just telling you if your earnings are increasing, okay, there could be a possibility that your variable cost would have been less or your fixed cost you would have reduced, by achieving economies of scale, large scale production, where your fixed cost would have come down. That way there are possibility where the company may happen to save out on EBIT. Okay, so this will become 40, 40 and 35. If you have to calculate 20, 17,500, difference between the two remains this. Okay, 50% tax is applied on the earning before tax. Now again, because you don't have anything, you will have to do division, subtract between the two and find out how much is the earning available to equity shareholder. 20,000 to be divided by 15,000. 20,000 divided by 15,000 will give you approximately 13.33. 14,000 divided by 10,000 will give you 14, and 17,500 divided by 10,000 will give you 17.5 as earning per share. Okay, so this will become 20,000 divided by 15,000, adding both together, 14,000 divided by 10,000 and 17,500 divided by 10,000 number of shares that you have calculated. So these problems are as simple. It's just very important for you to start reading the question very carefully. These are just forms. They're trying to ask you as to which particular alternative which you suggest that is going to give you better returns. So in the first one also, if you are comparing between equity and debenture, equity is something that is giving you the highest of returns. So if you have to mark your recommendations or give any suggestions to the company, it's seen that the debenture is one investment that is qualifying with the highest of earning per share to the equity. There should be one question between every student. Why are we considering only from the point of view of equity? Equity people or equity shareholders are also called as the owners of the company. And when any individual is actually framing as a part of working of the company and using all its intellectuals, so they are the ones who always concentrate on profit maximization. That is why from the angle of profit maximization, we look for an answer which is giving the highest of returns to the owners of the company. Okay, so that is why we select this one. So in the second alternative, when you're talking about EBIT is increasing to 10,000 or your EBIT becomes 40, old plus 10, 30 plus 10. Here also, debenture is something that is giving you the highest of returns. So whenever it is expected for you to write the suggestions of the company, you will have to mention that since investment in the form of debentures is yielding the highest of returns to equity shareholders in the terms of earning per share available to equity shareholder is the highest in plan 3, or you can say alternative 3 is the highest, hence this is something that is advised to the company. Okay, so this becomes the entire answer and the conclusion. So generally these kind of questions could be asked for 6 marks or 8 marks depending upon which type of university you're actually appearing for, and these are the answers. So next question is completely out of missing figures, completely new concept and a new variety of a problem. So basically this is variable cost as a percentage of sales. That means whatever is the sales, variable cost will be 2 by 3 percentage of sales. So if sales is hundreds, variable cost will be 66.67. So if you have to convert 2 by 3 into percentage form, this fraction will become 0.67. 75% of variable cost and 50 for C. Interest expense is going to be 200, 300, 1000. Operating leverage ka degree and degree of financial leverage. So 5 of 1, 3 of 1 and so on, the information continues. Income tax rate is given 50% equal for everybody. Now the question is, till now we've been dealing with problems which have given either direct sales, contributions, EBIT. Now this is one question that is completely indirect and full of missing figures. So initially what you're expected to do is start preparing the income statement. So with the help of the income statement, we have written all the information first, that is sales, variable cost will give you contribution, less fixed cost, EBIT. So entire format of the master table is already created, and what we have written here is interest, because in the given question the only piece of information that is available is interest, right? So this we have completely replicated in the income statement here. Now what is pending is, with the available information we are expected to find all of these missing figures. Okay, now what exactly are we going to start with is, first we are going to go in the reverse order, okay, and find out what type of information is already available. Now if we have to find earning before tax, cannot happen, so the only way left is to find out EBIT, right? So if you have to find out EBIT, the formula goes like this. Now why exactly we are doing EBIT, it should be very clear, because with the available information what exactly we do, we are just going backwards and we will find what is the value of EBIT. So in order to find out EBIT, what formula are we going to pick up? Now from the available information we have operating leverage and we have financial leverage. So the base is given, in attachment to the base the missing figure values are given. Okay, so the base is going to be always 1. Now we are going to pick up firstly the financial leverage, for obvious reasons that when you are calculating financial leverage, generally the formula is going to be what? EBIT divided by EBT. Now if you have to split this formula, it can also be written as EBIT minus interest, right? Either I write EBT or I write EBIT minus interest, also will mean the same. Similarly, EBIT divided by EBIT minus interest, and using the financial leverage formula and with the available information that is interest, we will be capable of finding EBIT. So how do you compute? The formula is going to be EBIT divided by EBIT minus 200, because this is the only information available, and the value is going to be 3 like it is told here. So 3 we replicate, this we are going to cross multiply. So 3 into EBIT, 3 EBIT, 3 into 200 is 600 equals to this EBIT comes here. Now when we are creating a calculation between left hand side and right hand side, what do we do? 3 minus 2. 3 minus 1 EBIT will become 2 EBIT equals to 600. 3 minus 1. EBIT will be 600 divided by 2 will give you 300. So similarly you will also have to calculate for the second and for the third one. which will come down to EBIT of 400 and 2000, right? So when we already have found out the information, let us make a note of it. So this becomes 300, this is 400, and this is 2000. Now with the available data, what can we do? We can compute things later. 3 minus 200 is 100, 4 minus 3 is 100, and 2 minus 1 is 1000. Right? 200 minus 100, I mean 50% tax on the EBT will become 50. 50% of 100, 50. 50% of 1000 will become 500. Right? And if we have to compute this further, this will become 50, 50 and 500. Now, the answer that is available to equity shareholder is already found. But do not stay down to the point that if you found this, you are going to stop the problem. Please don't see that. The above remaining costs are also available. Now, reason why is because there are other leverage also that is given. That will directly mean that you have to calculate the above information also. Now, if we have to again go back, so from the interest we went back and calculated EBIT. Now again we are going one step forward to find fixed cost or actual cost which are incurred, which cannot be found out by a following formula. So let us take one step forward and let us try finding contribution. Okay, now if we have to find out contribution, what exactly will be the formula we will use, and with the available data, how are we going to compute that particular formula to find contribution? Now to find contribution, we will basically use the formula operating leverage that is left. So financial leverage is already utilized. The only formula pending is operating leverage. So this particular formula we will compute, and this particular formula we will put this in this particular format. So formula is going to be contribution divided by EBIT, earning before interest and tax. So if we compute it like this, contribution equals to C divided by 300. Now why are we writing 5 here is because one constant amount of number is already given as compared to the base, right? So to find one value equal to contribution by EBIT. Okay, operating leverage, what kind of value component is given? If we cross multiply these two, now how did we get EBIT? This is the value that is already computed here, right? We have already computed using this formula here. So the same thing we will replicate in this particular formula, and we will get these numbers. So 5 3s are 15, 6 4s are 24, and 2 2s are 4000. So my contribution will become here. So we will start filling up the numbers. This is 1500, this is 2400, and this is 4000. So we have contribution, we have EBIT. So it is very obvious the difference between these two only has to be fixed cost. So if we write 1200, 1500 minus 1200 is 300. 2000 matlab this is going to be, the value of fixed cost is going to be 2000. If you deduct the value, remainder will become 400, and here obviously it is going to become 2000. Alright, now most important thing that we have to find out is with respect to sales. Right, now before finding sales, we already know what is the percentage of variable cost in sales. Okay, so for example, if you assume that sales is 100, that means variable cost will be 66.67% of sales. Okay, here what we have to do, if you want to find out the value of the sales, contribution is one important element that is a part of these two. From sales, if you reduce 66.2 by 3 or 66.27, whatever is the remainder becomes the contribution, right? Agreed? If this is 100 and if I minus variable cost, whatever is pending becomes the contribution. So for easy example, if this is 50% here in the case of C, if sales is 100 and 50% is variable cost, the remaining 50 becomes contribution. Agreed? Just keep this into mind. And now what we are going to do, we are going to find what is the percentage of contribution in sales. Percentage of contribution in of sales. Okay. Now this is what we are trying to find out. So if variable cost is so much, what will be the contribution? If variable cost is so much, what is the contribution? If variable cost is so much, what is the contribution, right? We have these ratios. Now this particular ratio has to be computed in this formula. How? 1500 into 33%, that is contribution of 100. Okay, so the total amount we will try to deduct 33% or bring a full ratio of sales in it. Okay, sum up to its sales and then find out what is the value. We are not expected to do 33% of this much. Find out what is, if this was contribution, then what would have been the sales. That is what we are expected to find out. That is why we do 1500. Now where did this 1500 come from? It came from contribution. So if contribution was 1500, that is 33%, what would have been 100%, that is of sales? Correct. If 33% is equal to 1500, what will be for 100%? That is what we are trying to find out. So you will get 4500. If 25% is equal to 2400, how much will be 100%? Okay, that is what we are trying to find out, and this is the value that we arrive at. So if we get 4500 here, we will get 9600 and we will get 8000. Right? Now, for a clarification, if it so says that variable cost is 50% of sales, now let us just compute. If the variable cost is 50%, 50% of 8000 is 8000 minus 4 is 4. Now let us take one more thing. It says 75% of variable cost is a percentage of sales. Now if I compute 9600 into 75% will be 7200. 7200 minus 9600 is 2400. Okay. 4500 into 66.67% is 3000. 3000 minus 4500 is 1500. So this is exactly how you go about finding missing figures out of the given problem. So the only thing that is to be understood in the last aspect is that if 33% is equal to 1500, how much 100 will be for? It will always be a value higher. That is what you are expected to find out. And the value of variable cost you will have to find out. You can either do 4500 minus 1500 and then find out, or you can also cross check your answer whether it is correct or not against the percentage that is given by the question. So for example, it is 50. 8000 into 50% will be 4. 8 minus 4000 is 4. So here you can easily stand and tally up your data. So this kind of problems are generally seen for section C, or it could be for 12 or 14 marks depending upon the type of university that you have chosen and the papers that you appear for. Most probably these questions are asked, and these kind of pattern of questions could be asked. This is very important, has been seen in many previous year question papers. So all are expected to please go through this very properly. See you then.